Okay, I think we've got critical mass and some more folks will be joining as we get started, but in the interest of time, let's go ahead and dive right into it. So first of all, welcome to our Western Markets webinar. My name is Nathan Miller. I'm a director here in E3's Asset Valuation and Markets Group, and I lead our market price forecasts across North America. I'm joined by my colleague, Vivian Lee, who heads up our WEC market forecast, and she'll be covering most of the content today. So obviously these days, it's been a busy start to 2025. There's a lot going on in the energy industry today. Probably as all of you are quite familiar, the cone of uncertainty in our minds is a lot wider than it has been in some time, and it continues to widen with continuous actions at the state, local, federal level, and just in the markets themselves. Amidst all of this uncertainty, I think forecasts are continually important and fundamentals do matter. So we definitely over here at E3 believe that tracking those fundamental cause and effect relationships is really critical to help separate and identify the signal from the noise to create realistic market expectations. So first off, before we really dive into the content here, wanted to go over a couple of housekeeping items. So first off, as you'll all note, all attendees have been placed in listen-only mode. This is just to manage the large webinar chaos that can ensue. If you have questions, please type them in the chat box. There's a Q&A log, and we'll be able to see those questions throughout the webinar. You don't have to wait till the end. Also, if you have any questions that you'd like to submit directly to us in writing, please feel free to do so at marketprices@e3.com. Those emails do get picked up and read by all of us, and we look forward to engaging with you in that way as well. We also plan to send around a copy of the slides that we'll be going over today to all of the registered attendees of today's webinar. So without further ado, let's go on, and this is the, necessary quick primer on who we are and why we're here. So who is E3? Many of you are probably familiar with us, so I'll keep this brief. We're a data-driven technical consulting firm. We specialize in the electricity sector. We've been around for 35 years. We have about 130 consultants right now across 5 offices in North America: San Francisco, New York, Boston, Calgary, and Denver. We completed over 300 projects per year, and we have a pretty diverse client base, really that we think of in 3 broad categories, though some clients span those categories or fit into their own. We have investors, developers, and asset owners as the core commercial clients of ours. Then we have utilities and system operators, and then public sector agencies, including policymakers, regulators, and nonprofit organizations. We really appreciate the opportunity continuously to work with such a diverse client base across the industry, because in our minds, it's really important, especially in times of change and transition, to understand and appreciate all the different perspectives from stakeholders coming at the industry from their own respective areas of focus, either a customer or a seller or an investor or a regulator or a public policymaker. All those perspectives and interests obviously need to come together and interact to form the market dynamics that we observe. So we really work across these areas and gather insights from these various client groups to inform our market outlooks, and then our market outlooks in turn inform our work with each of these groups. So going on to the next slide, I'll tell you a little bit about our 3 practice areas. We organize ourselves at E3 into 3 broad groups by subject matter focus. On the far left, you have the Climate Pathways and Electrification group, dealing mostly with questions of policy and decarbonization. Lately, that group has also been focused a lot on forecasting and kind of data-driven approaches to understanding the electrified load shapes from vehicles, light-duty, medium-duty, heavy-duty vehicles for transport, as well as fuel switching and increasing essentially energy consumption envelopes in buildings across different weather conditions and different jurisdictions in the United States. Then we also have an integrated system planning group kind of in the middle that takes all of the policy and the load data from our first group and really brings that to bear to assist utilities primarily, as well as system operators and others, with their integrated system planning or resource planning. And so this group does a lot of capacity expansion modeling and resource accreditation, loss of load probability work, and really deep technical studies that also inform and help our clients do resource planning and procurement. And then finally, there's the group that Vivian and I sit in, which is the asset valuation and markets team. And we really work a lot more more with our commercial clients, our investor developer clients. We also work across some of our other client types as well. And we really specialize in the market side of the equation. What's happening? What is the value stack of different resources? How is it changing over time? We do a lot of production cost modeling, as Vivian will cover. We produce our market price forecasts, and we also use those and other tools to inform our strategic advisory for new technology companies or go-to-market strategies for companies, as well as the market forecasts themselves. So with this, I will turn it over to Vivian, and she'll be taking us through the rest of our content for today. Thanks.
Okay, so thank you, Nate. As a sneak preview of what we will be talking about, so our talk today will be structured in primarily two segments. So in the first, we'll be talking through the primary forecast drivers. So these are key things that we think will be driving prices. And then in our second kind of segment, we'll then be diving into a discussion of the prices themselves and our forecast and how we kind of see these evolving going forward. To kick things off, just a quick overview of the Western markets. And so, as you know, one of the key defining features of the West is just the fact that it's one of the largest remaining areas that is not yet kind of dominated by these major organized energy markets in the same way that, for example, the Eastern interconnection is. And so really in the West, California is pretty much the only area that has an ISO and that has a wholesale energy market. So everywhere else is pretty fragmented in the sense that it's, the transmission reliability and balancing kind of the job is handled by these individual balancing authorities. And so, yeah, so in that way, this does make the West a little bit more complicated than the Eastern interconnect, and that there is a lot more fragmentation and a lot of players. For today's talk, we've identified 4 key themes that E3 sees as dominating the Western markets. So this is just a quick kind of overview, as I said, and so we will be diving into each of these topics in fuller detail in the upcoming slides. But just to kind of kick things off and tee things off, so number 1 is policy. So what we see is that this region has adopted very strong clean energy policies, and we see this as increasingly starting to define the market in the sense that these clean policies are what drive load-serving entities to go forward and procure more and more clean energy. Number 2 is load. So we do see load as something that will start to grow again. And so this is contrary to what we've seen in kind of the historical record of the past 20 years where load has been very flat. And so because of things like electrification trends, as well as large loads starting to interconnect, and this is mainly data centers, we do see electricity demands kind of growing again in the future. And then number 3, resource adequacy. So with the increasing renewable penetration patterns, as well as kind of expected peak load growth, this is all shown kind of like a light on reliability across the West as a whole. And so so there is a growing kind of complexity in terms of reliability planning that's pushing entities towards joining these regionalized reliability planning programs. And then number 4, along the same kind of theme as regionalization. So another kind of happening here in the West is that entities are also becoming interested in joining these large organized energy markets. And so there's currently an effort ongoing right now between LSEs to sort of decide between 2 options. So one of them being the market model set forth by CAISO, and then the other is the market model that's set forth by SPP. So before kind of like going into the details of the main content, we wanted to just provide a quick overview and to provide some context as to what our forecasting approach is. And so here at E3, what we really like to say about the price forecasting effort is that it really encompasses kind of the full brain trust at the company. And so what I mean by that is that we kind of touch on all areas that that E3 works on. And so we take learnings from all of these various sectors. And then we like distill those learnings into the forecasts themselves. And so our forecast inputs, for example, are really good representations of how E3 internally is kind of seeing things evolve over time. In terms of philosophical approaches, how we approach price forecasting is from a fundamentals point of view. And so what that means is that we really model the system from the ground up in order to sort of capture those changing dynamics as the system becomes cleaner and cleaner. In terms of like the actual in terms of the actual forecasting process, we can describe this in kind of two stages. So the first is long-term capacity expansion. And so this is really the stage that's kind of involved with understanding and deciding on the new resource additions for your system. So this is stage one. So having defined how your system will change over time, then we run stage two, which is production cost simulation. And then this stage is really kind of more involved with running optimized dispatch. And so the outcome ultimately of our price forecasts from the modeling perspective are these raw day-ahead energy prices by zone. And so we'd also like to add here that once we have our raw prices, we then take them and post-process in a very pretty like rigorous benchmarking step. We then try to factor in any sort of considerations that we see in real life that can't necessarily be captured on a fundamentals basis. So this includes things like consideration of scarcity behavior, and also things like opportunity cost. And so we do factor these considerations into the final day-ahead energy prices themselves. The last thing that we wanted to sort of highlight here is that in addition to energy forecasts, we also offer forecasts for a variety of different market products as well. And so this includes capacity, ancillary services, and RECs where available and where relevant. In terms of how we develop our market products, we develop them in consideration of each other. So that we are able to kind of just like capture the impacts of one market product on another in terms of like impacts to energy or impacts to prices and things like that. And so in that way, our suite of market products that we offer is very comprehensive and also, and also interact with each other fully. And the other thing we wanted to just do here quickly is to shine a light on E3's recost tool. And so this is sort of the newest addition to the modeling family here at E3. And so for our internal modeling and analysis needs, E3 has developed this discounted cash flow model, which calculates these levelized fixed costs for a variety of different technologies of interest. And so for us internally, this is very useful, of course, like not only with our modeling efforts, but also to help inform our other, valuation analyses, and also for our internal kind of like planning processes and planning analyses as well. And so just wanted to note here that this recost tool is available for purchase if the interest is there. So if you are interested, then please feel free to reach out to the team. Okay, so moving into sort of the main content of our talk today, where we'd like to start off is with a discussion of policy. And so as a whole, the thing that sort of like what we really wanted to highlight here is that the West is targeting nearly 100% zero greenhouse gas emissions generation by 2050. And so not only are states themselves setting these very aggressive clean energy policies, which you can see in the dark blue, but where the states might be lacking a little bit. So for example, with Utah and Arizona, the utilities are really kind of stepping in to fill in the gap with their own internal goals, which are just as aggressive as the states across the West. The main effect of these targets together is that, as we said earlier, that they are driving the market for clean energy, in the sense that these targets pretty much provide guidelines for the load serving entities to then go out and then procure more and more clean energy. Another sort of adjacent topic here, having talked about policy, is also just a discussion of load. So how will load grow into the future? So yes, before diving into that, just a quick look at historical numbers to provide some context. So historically, really across the last 20 years and starting around the early 2000s, you can see that load growth has actually been pretty flat and low in general. And this is true both on a regional basis, so on the right-hand side, and then also on a net aggregate basis for the US as a whole. You can see load pretty much has not grown since the 2000s. And so the reasons for this could be span like a variety of things, so including things like the fact that there was a stronger push for energy efficiency starting around this time. Population growth also slowed relative to the decades before that, and then there was also just like a fundamental shift in the economy away from manufacturing. So moving forward, we actually don't expect this trend to continue, and we actually expect load to pick up again. And we think that this load growth in the coming decades will come largely from a couple of areas, so electrification and data centers. And by electrification, what we mean here is really two segments. So one is electric vehicle adoption, and then the other is building electrification. So this is things like the adoption of heat pumps and fuel switching. So digging into, I guess, the regional kind of trends a little bit closer, if we look at California, we do expect most of this load growth to come from EVs. And the reason why is kind of twofold. So both like fundamentally, California is one of the states that has some of the heaviest dependence on personal vehicles. Then on top of that, California also has very strong EV targets, and that's in part driven by the state's economy-wide greenhouse gas reduction goals. So that's the story for California. For the Pacific Northwest, building electrification actually contributes a little bit more to the narrative here. And the reason why is because, of course, the climate is a little bit colder, and so winter load is higher. And then also there's kind of a disturbing trend in the summers where the summers are getting hotter. And so a lot of people actually are adding ACs where they've never really needed cooling before in the summers. And so both of these things basically just contribute to the greater heating and cooling load needed in the Pacific Northwest. So it's a little bit different. And then finally, the desert Southwest. So the interesting thing to kind of point out here is that the Southwest is expecting a lot of interconnection of new data centers as well as manufacturing load. And then the reasons for this are a couple. So the first is just proximity to California. So some of the data centers will be serving California load. And then also on top of that, in conjunction, the Southwest in general just has relatively cheaper land and also fuel costs. So these next couple of slides here that we have provide a little bit more insight into how E3 is viewing data center demand, and then also the implications of that for the future. In terms of data center load, of course, data centers have substantial energy demands and the capacities that they need are very high. And so from this perspective, they're very meaningful in terms of their impact to the grid. The question here, however, is that there is still a lot of opacity. It's very unclear how much load actually will be demanded coming into, how much load will be demanded in the future. And then on top of that, also how much is more realistically, I guess, available to be interconnected. And so those are the open questions so far. In terms of data center load forecasts, these tend to vary pretty substantially. E3 itself does maintain our own forecasts, and so this is something that's like evolving over time, and we do update this pretty frequently depending on our new learnings and how things are changing. The thing to kind of highlight here is that our view is that grid constraints will be a limiting factor on data center power forecasts or demand forecasts. And so the question here, of course, like involves both sides of the coin, both on the supply side and the demand side. So a couple of like key topics that are really hot right now are one, interconnection challenges. So these are like questions around how much new generation can be connected, and whether or not there will be delays there. And then the other kind of key thing that's sort of hot in the news right now are issues around and concerns around rate payer impacts and customer affordability. And so, as I said, so this is a topic that is constantly evolving, and this is something that E3 does have our kind of like finger on. It is tracking, but we do expect things to kind of change over time. Okay, so moving on, having talked about the demand for clean energy in the coming years, the next sort of topic here is really just to define how much is exactly going to be needed and like what will be built. And so again, just taking a historical perspective as a first kind of look here to provide some context. Across the last 7 years, what we're showing is starting in 2017, we see capacity additions in California, the Northwest, Desert Southwest, and aggregate kind of picking up over time. So you could see in the beginning, around 2017 to 2019, most of these additions were really just around renewables, so solar and wind. And then starting in 2020, this is where we start to see batteries making more of an appearance. And so this really corresponds to a couple of things. So one, battery economics, and the system is just becoming more favorable economically for more storage to be added. And then this also corresponds to when California's CPUC's midterm reliability order, which is a central kind of procurement order that basically tells LSEs to go out and buy more battery storage in order to meet some RA targets. And so, yeah, and so you can also see likewise, battery capacity additions start picking up starting in 2020. We do see this trend continuing to kind of go forward in the coming decades. And so this is true across the West as a whole. In terms of what kinds of resources will be built for energy, you can see that predominantly most of the growth will be from solar. And this is just due to the fact that solar is very abundant. Of course, California and the Desert Southwest has some of the best quality solar, so there's a lot of it being built in these regions. In the Pacific Northwest, solar is still a pretty big part of the picture, but you can see relative to the amount of solar that gets built, there's also a fair amount of wind in the Northwest. And so that's because the Northwest also has access to some really decent, really good quality wind coming from Wyoming and Idaho. In terms of what capacity will be built for the West, that question is kind of revolves around three considerations. So the first is really just system dynamics. So for example, in the Northwest, storage has really low ELCC, really low capacity value because of the fact that there is so much hydro already. For California, there's political sentiment considerations. For the Desert Southwest, the question of how much storage versus CT will be built also has some considerations of how much pipeline, for example, like gas pipeline will be needed, like if you need more or, things like that. So yeah, so that kind of wraps up our discussion of capacity. Moving on to sort of the next topic, which is reliability. So transitioning towards these like systems with a lot of renewables and storage also introduces this additional layer of complexity to resource adequacy planning that wasn't really there before. And so as this happens, at the same time, we've also seen a lot of extreme weather events happening too, and changing weather patterns. So we've seen heat waves, we've seen cold kind of spikes as well. And so all of this is adding to complications around reliability planning and kind of like bringing forth resource adequacy as a critical area of attention in the West. With regards to how things have been done historically, so historically, effectively, all of the load serving entities sort of just planned for themselves. So not a lot of cooperation or coordination, I would say. Not a lot of consideration on a broader regional level, and the methods and approaches taken by each of these load serving entities were very different as well. Moving forward, there has been growing interest in the regionalization of resource adequacy planning. And so, for example, you probably have heard there is a program that is under development called the Western Resource Adequacy Program. And so this is really a planning and compliance program that is being developed, and there are 20 entities just across the West that are interested and that are official participants. The idea is that RAP will provide guidance in terms of how to kind of value capacity, and then also in terms of planning for how much capacity will be needed. So instead of these individual LSEs kind of planning for their own systems, the region will be kind of planning for a system-wide peak. In terms of timing of RAP, the program is expected to become fully functional sometime in 2025. And then in terms of when it becomes binding, that's a little bit further out and expected to start in 2028. There are a couple of direct benefits of reliability regionalization. So the first one being load diversity. And so effectively, what we mean here is that when we think about coincident peak for a system, it's typically lower than the non-coincident peak. And so effectively what this means is that the capacity requirements needed when you consider things on a system-wide basis will be lower, which translates to some savings. And then the other issue is around the other benefit, direct benefit, is around resource diversity. So the idea here is basically that when resource accreditation is sort of considered on a system-wide basis in aggregate, this effectively resources get more accreditation because in some sense the loads are able to sort of like lean on each other and share their resources. So those are direct benefits, but of course there is also the secondary benefit that's also pretty important. We also wanted to highlight, and that's the fact that moving towards a more standardized approach across the West with something like RAB will also provide more clarity and structure to the way that reliability is done. And so hopefully, for example, this will help streamline, data around bilateral contracting and things like that. Okay, so this next slide provides some additional context on as to like the benefits of RAP. So E3 has done some high-level analysis in the past, looking at some, theoretical max benefits of RAP. And so looking at just kind of the historical data and looking at the coincident versus non-coincident peak, we do see a 14% reduction in the coincident peak relative to the non-coincident peak. And so, of course, like I said, this is just very high level. This is just meant to provide some like context. But yeah, 14% is pretty sizable. And so this should translate into some pretty interesting savings for participants. Okay, so this is sort of the last kind of factor here, but along the same kind of theme of regionalization, as we mentioned, load serving entities are becoming more and more interested in joining like energy markets, regional energy markets. And so how things are done historically, again, just starting off with a historical context. So right now, basically BAs are able to trade with each other. So they're able to do bilateral trading, but this trading is very inefficient. And, there's a lot of like transactional friction in the sense that these trades are not happening on the same level of efficiency that you would with a real kind of organized energy market where everything is optimized. And so moving forward, effectively participants joining these large regional energy markets expect to see savings because you're kind of getting rid of a lot of these barriers to liquid trading. And so trading should become much more efficient. In terms of what the final kind of benefits will look like for each load serving entity, as well as like the two markets under consideration, that will depend largely on how the actual kind of footprint of the two markets ends up shaking out in the future. And so that is something that is kind of still ongoing. And decisions haven't necessarily been finalized yet. In terms of where things are right now, so some participants have already announced their intention to join EDAM, which is California's day-ahead market. Some participants have announced already their intention to join Markets Plus, which is SPPs, but there are lots of entities that are still kind of deliberating their choice. And of course, like some entities, some players will have a bigger impact than others. So for example, BPA is a big player here because of the fact that they own a lot of transmission. And so, like I said, this is kind of like an evolving area and things are still happening. And so the actual final, the final results and the final benefits and such for the various markets and the entities will depend on what the final footprint looks like. But either way, it will shake things up in the West. Okay. And so that kind of wraps up our first segment of the discussion of major forecast movers. We can move on to the second segment, which is our discussion of prices. But before kind of diving into the actual prices themselves, we also wanted to just provide some context as to what exactly we're providing with our energy price forecasts for each of these different regions in the WEC, because it can be a little bit nuanced. So what we wanted to just note here is that we do provide forecasts for pretty much every area in the West, but it's a little bit different in terms of what the forecasts themselves are meant to capture and to represent. So, for example, California is very straightforward because CAISO is a market, and so the energy prices that we provide are meant to reflect day-ahead market prices at the transmission hub. With regards to the two trading hubs that we provide prices for, so this is Mid-C and Palo Verde, what we forecast reflects hourly day-ahead energy prices traded at the hub under current market dynamics in the region. And so basically what we do is we take our fundamental outputs from the model and then we adjust them to reflect kind of the trading dynamics and opportunity cost considerations that we currently see in the data with regards to trades. And then finally, with everywhere else, like for all other balancing areas, we are able to provide energy prices, but we wanted to note that these prices are simulated hourly prices and they represent more of like a avoided cost perspective. Okay. And also just a quick look here at gas prices and our gas price forecast. In general, the thing to kind of just like point out here really is just that the West is very large, expansive, I guess, from a geographical perspective. And so what this means is that delivered gas prices across the region can differ pretty substantially, just depending on how proximal they are to different major supply centers and also to different pipelines. And so a few things to kind of just like note here as topics of interest. So for example, in eastern New Mexico, we have a lot of gas production from the Permian Basin, which helps keep prices at El Paso Permian, for example, pretty low. California, on the other hand, has some of the highest delivered gas prices in the West. And then pricing dynamics in the Pacific Northwest is interesting in the sense that they can reflect not only market conditions in the Pacific Northwest itself, but also from upstream in British Columbia, Canada. So just a some quick context there. Moving on to our energy prices themselves. So this is a first look at our day ahead energy prices. And so this is showing monthly averages. And so if you look at the historical prices, you can see that historically there are kind of two seasonal peaks. So one in the winter and then one in the summer. The winter peak is largely driven by high gas prices, which kind of peak up in the winter due to demand. And then in the summer, we generally see the energy price peaks in the summer coming from scarcity events. So this is like load being really high and then supply kind of being maxed out. In terms of going forward, how we see day ahead energy prices moving on average is that we continue to see seasonal kind of trends staying as they are. But with regards to annual averages, we do see these kind of picking up and tracking with growing load as well as increasing gas prices and carbon prices. And so we do see a slow kind of tracking upwards in terms of annual averages. A few other kind of useful and interesting kind of things to point out here in terms of energy prices. The first is that California and the Pacific Northwest have carbon prices. So they're under carbon programs, and so the end effect of this is to boost up the energy prices that we see in this region or in these regions. At the same time, the Pacific Northwest also has a lot of hydro in its portfolio, and so the impact of the hydro, of course, is the opposite in the sense that it tends to pull down average energy prices. And then finally, the other kind of interesting thing that we wanted to just sort of note here is that the traded prices that we show for Mid-C and Palo Verde are influenced by the opportunity costs of trading into CAISO. And so what that effectively does is it helps bring the averages closer to each other. And you can kind of see this most especially during periods of scarcity in the summer. The second look here is just at hourly averages of day ahead energy prices. And so the thing to kind of flag in general across the West is that the duck curve does continue persisting and it gets a little bit deeper going forward. As we add more solar into the system, the frequency of negative prices is expected to increase. but at the same time, it is counterbalanced by a couple of other dynamics. One of them being we continue to add storage to the system, which helps kind of soak up that excess solar. And then the other is like, of course, like load itself continues to grow. And so these kind of counterbalance the impact of solar and midday. Additionally, with regards to the depth of negative pricing, so this is a very complicated topic, and it does reflect a number of different factors, which include kind of like things including supply and demand dynamics. So how much REC there is versus how much demand there is. There are also considerations regarding like how scheduling coordinators might be valuing renewable credits, and then also like how they might be strategizing their the way that they bid. So these are all kind of factors that affect depth of negative pricing. And then I guess suffice it to say that we do include our own views of how we see negative pricing kind of continuing to evolve going forward into our price forecasts. Okay, so moving on to the REC prices. In general, REC prices in California have been very high in recent years. And we do see this as being driven primarily by the fact that demand is exceeding supply. From a fundamentals perspective, a fundamentals like forecasting calculation perspective, which is the approach that we take with our REC calculations here. What we see is that moving forward, we do expect REC prices to kind of have a slight downward decline over time. And this might be counterintuitive or like surprising given the fact that so much new solar is expected to come online. But as I mentioned earlier, we do see some counterbalancing effects with the fact that load is continuing to grow substantially, and we do add a fair amount of storage, especially in the desert Southwest and California. The other thing to sort of note here, the interesting trends, is that from a magnitudes perspective relative to each other, you can kind of see that in 2035, the price points here, the PNW has the highest REC price, and then that is due to the fact that it coincides with also the least quality solar. And then the opposite is true, where the desert Southwest has some of the highest quality solar, and likewise it has fairly low REC prices. And then finally, kind of the last thing to sort of flag here is that from our perspective, we do see RECs as being kind of the fundamental marginal REC resource in the West. And that's just due to the fact that it is so abundant. And then, yeah, wind just has slightly more constraints geographically than solar does. Okay, and then this is our last slide on prices. So this is taking a look at the capacity price forecasts that we maintain here. Just as like a reminder, there is no formal capacity market anywhere across the WEC, not even in California. And so what we provide here are kind of like what expectations of bilateral trades in our forecast. If we are to look at the historical prices in California, it's pretty interesting in the sense that starting off around 2015 through about 2018, RA prices were actually fairly low. And starting in 2019, we can see RA prices picking up. And so this coincides with a couple of things. So one of them is the extreme weather events. And then the other, of course, is some concerns around the retirement of large thermal units in California. So these are like the OTC units, the ones with cooling units. And then also Diablo Canyon. And so really the uptick coincides basically with the concerns with RA in California. Where RA stands today is that RA is still pretty elevated. Over time, we do expect RA to kind of increase steadily as energy margins kind of erode slowly, and also as ELCC of storage kind of wears down. In terms of what is setting the RA prices in our forecast, for the Southwest, we see this as being both gas and storage, depending on the year. And then in the Pacific Northwest, as I said, storage tends to have very low ELCC. And so what that means is that we generally see gas playing a pretty large role for capacity value in the Northwest. And then of course in California, the CPUC's midterm reliability order has effectively set storage as the marginal resource in California today. And then, yeah, moving forward, continuing to be 8 hour as ELCC for 4 hour wears away. Yep, and so yeah, so that kind of wraps up our discussion of prices. This last slide here is just a summary of kind of trends that we've been seeing in the that we've already talked about. And so just really quickly going over the key points here. So the first is just that we continue to see firm capacity being very important for the West and supported by the fact that load peaks are growing and that there are substantial resource adequacy concerns with regards to energy prices, renewable penetration will continue to drive duck curve shapes, which we've shown in the previous slides. And then number three, we do see gas prices and carbon prices continuing to help drive up energy prices on a nominal basis. The reason why is because going forward, we do still see thermal units setting the marginal price in many hours of the year. Okay, and so that kind of wraps up our main content. The last slide here is just some final remarks and notes, I guess, to make. What we wanted to highlight also and bring forth is just the fact that we do consider our market price forecasts to be very bankable, and we have supported a lot of utility and asset transactions with our forecasts already. In terms of what you get when you purchase a forecast package, this includes not just the forecasted prices themselves, but we also provide a lot of detailed assumptions. And then we also provide a kind of like a detailed market summary deck report. If you do have additional questions, or if you are interested in pursuing some custom cases or nodal analysis, these are projects that we frequently take on, so please feel free to reach out to us. And then if you have additional questions or want to see more information about purchasing the price forecasts, you could go online at e3.com. And then just flagging that we do have a discount code available here, webinar 10, and then you can use it online to get a 10% discount through the end of the month. So yeah, so that wraps up everything I had to cover. So I'll just pass this back over to Nate.
Thanks, Vivian. So that concludes our official content for now. We do have a couple minutes to take some questions from the chat. So let's see kind of what we have from questions that came in. Just a couple of them, it looks like. So one of them is a question about essentially the EDAM and Markets Plus footprints and how we consider those in the price forecast from the topology that Vivian had laid out. So I'll just expound on that for a minute. It's a good question. Of course, as you know, everyone in the West is still waiting for some key decision makers and key balancing authorities to decide whether they're going with the California ISO's extended day-ahead market or the Markets Plus, regional market initiative. And we've seen some of the utilities break one way or the other, but the entire footprint of the Western Balancing Area authorities is not yet finalized. So how do we consider this in our long-term price forecasts? We sort of adopt a middle way, essentially. And so what we do is we, as Vivian mentioned, we model each of these transmission zones, these balancing area authority zones across the WEC. And in the production cost modeling of PLEXOS, we apply sort of today's wheeling charges between each of the zones, and that goes into the dispatch logic, so that, if generation is going to have to move from one place to the other, it needs to pay the wheeling charge of today's transmission system rates. And so what that does is it sort of gives us a long-term view of kind of the core system costs if the entire West were dispatched kind of as a whole, but the wheeling charges between zones were preserved. So again, kind of a middle way. It does not assume any particular break or split in the market footprint, but it still gives us kind of a pretty good idea of which way power is going, kind of all else equal, and what kind of locational marginal prices based on existing transfer capability limits and prices of those wheeling charges look like. As the dominoes kind of finish falling in the coming months, we do expect to refine our Western case to reflect a emerging market footprint of who's in one market, who's in the other, and what that scene may look like. And so that's something that we're actively tracking and working on as well as a company, and we'll be updating in the future. Let's see, any other questions that we have to address now? We had just another question, obviously, on data center loads. So it's a good question. Essentially, it kind of is asking, how we go about forecasting data center loads in the WEC, and in particular avoid kind of double counting, because everyone knows it's similar to interconnection request queues. Data center developers are according multiple different utility service areas with their load requests. Essentially, what we do is we take a top-down and bottom-up hybrid approach to forecasting data centers. The bottom-up is identifying not just today's operating facilities, but a high likelihood planned specific facilities by footprints from a couple different sources. And then we, sum all those up by region location of these specified facilities, and we compare the aggregate total in the near term to a series of industry report averages of the total growth of data center loads in the WEC as a whole. And we do this kind of across the country, across ISOs. That helps us calibrate the sum of the individual parts against the various estimate envelope totals across the region, and come up with a sort of middle road consensus estimate that we also refine based on utility service territory's ability to integrate those data center loads over a particular time frame. So we kind of take all that into account, so that we're not just taking sort of posted forecasts as given, essentially. Let's see. And then we had one more question just on custom cases, as Vivian mentioned. So we do provide custom cases. Our off-the-shelf case is an E3 house view. It's our core case. And we use that for a lot of our work, and has been, has stood the test of investment committees and transaction processes many times. And I'm sure we'll continue to do so. If clients want to see a custom sensitivity or a custom scenario, multiple vector levers changed over the course of the forecast, that's something that we do all the time and can certainly provide, price and timing estimates for that. So please let us know what you're looking for, and we'd be happy to work with you. Looks like those were the core questions that we had here. So with that, I think we can go ahead and wrap up our webinar session today. So again, thanks everyone for joining. We'll be following up with the slides by email with your registered email address. And yeah, we look forward to continuing to work with you all and hear from you in the future. Thanks.